Welcome to week 4 of financial statement analysis. In this video and in this week, we are going to be doing a high-level analysis of profits. As you can see here, there are 4 major profits. What? Not that type of profit? F-I-T-S? Oh, I guess that does make more sense. Can you send me the updated slides? Thank you. Sorry about that. We are going to be analyzing profits. On this slide, you see 6 performance ratios. And I know that you're familiar with them, you've calculated them before, you've probably been forced to memorize them in other classes. But what we're going to be focusing on in this class, after introducing the calculations, how these profitability ratios are defined, we're going to be focusing on getting into the data. We're looking at various companies, comparing their profitability ratios, looking at how the profitability ratios can change over time, and then also looking at median values for a large data set. This is important because, well, first of all, it's on the CPA exam. Performance analysis is on part of BEC, and it's also a part of FAR, ratio analysis. And the reason that it's so important for the CPA exam is that these are such important metrics that are used by management to analyze the performance of either the company as a whole or for a specific product or division or segment of the company. So it's really important that we are familiar with these measures. Now we're going to go into much more detail beyond this high-level analysis later on after we meet next Saturday. But for now, we're just focusing on a very high-level analysis. So please make sure you have your PowerPoint template so that you can take your notes along with this video and the Excel file that is going to go along with this video. Get started with gross profit margin. Gross profit margin is equal to gross profit, of course. Gross profit is equal to sales minus cost of goods sold. Gross profit as a percentage of sales. Gross profit margin measures the markup or the spread between the cost to make or buy a company's products and the selling price of those products. Declines in gross profit margin may be mainly due to one of two things: an increase in competition or a decrease in demand, leading to a decrease in selling prices in order to get people to buy our products. Or a decrease in gross profit margin may be due to an increase in the cost to make or buy our products. Such that the company can't pass along that increase in the cost to its customers. And we've seen a lot about increases in cost to make or buy a company's products in the news lately. What can a company do? A company can increase gross profit margin by increasing the selling price without decreasing sales volume. And of course, this is much easier said than done. Another easier said than done, decreasing the cost to produce the goods that are manufactured and then sold without decreasing the sales volume. Here we see the gross profit margins of Coca-Cola, Pepsi, and Monster Beverage Group. These 3 companies are going to be the key to the companies that we focus on in this video and this week. We see the dollar sales of revenue, the dollar amounts of gross profit, and then we see the gross profit margins. And what's important to point out here is that although Pepsi has by far the highest revenue, and look at the comparison of revenue for Pepsi to Monster, although Pepsi has the highest revenue, Coca-Cola has the highest gross profit margin. So what can we take away from this? Coca-Cola is doing a better job controlling its cost of goods sold compared to these other 2 companies. We can see that Pepsi and Monster, even though Pepsi is so much larger, has so much more sales, they have the exact same gross profit margin in the most recent year. Now let's get down to operating profit margin, also known as EBIT margin, EBIT standing for earnings before interest and taxes. We know there's more to the non-operating section of the income statement than interest and taxes, but those are the main items. And this, of course, is equal to operating income, or EBIT, divided by sales revenue. Every time we're talking about margins, we're putting sales or revenue, we're using those terms interchangeably. We're putting sales or revenue in the denominator. So when you see margin, you know that sales or revenue is that denominator. An operating profit margin measures the profitability of the company's core business operations. It's not influenced by investment income, interest expense, tax expense. And the reason that we look at it, the reason why we're interested in operating income that's not influenced by investment income, interest expense, and tax expense, is each of these three main items are less controllable and less predictable. And so when investors are doing their valuation models, it's harder to predict future net income because net income includes these items, and operating income should be more sustainable and predictable. Operating profit margin will be lower than the gross profit margin. An operating margin can be negative if the company has an operating loss in the period. As gross profit margin, you're not really going to see that to be negative because you're going to, you might not have a large sales number, but generally your sales are going to be higher than your cost of goods sold. Otherwise, you're going to be out of business very soon. How can we increase operating profit margin? Increasing sales revenue without an equal or offsetting increase in operating expenses. And that's going to be tough, of course. Those operating expenses, the sales, salaries, commissions, depreciation on those actual stores that we have, it's hard to eliminate those without seeing a reduction in sales revenue. What else would we see in operating expenses? Any expenses related to the corporate business, the accountant's fees, the lawyer's fees, salaries of your corporate employees, your CEO, your CFO. What else are we going to see in there? Advertising. So typically we need all of these items to produce future revenues, but to the extent that we can reduce them, we can increase operating profit margin. Also, so increasing sales revenue without a decrease in operating expenses, or decreasing operating expenses, it's just going the other direction, without an equal offsetting increase in sales revenue. Here we see the operating profit margins for our three companies, Coke, Pepsi, and Monster. Again, Pepsi has by far the highest revenue, but look at which company has the highest operating profit margin. So what can we say about Monster? Even though it didn't bring in nearly as much as sales dollars, it by far had the lowest relative operating expenses, and therefore was able to keep more of those sales dollars in percentage-wise compared to Coke or Pepsi. Our last profit margin is the net profit margin, which is equal to net income divided by sales. This metric is sometimes called return on sales. When we see the word return, think net income goes on the numerator, and then net income compared to, of course, sales. And it measures the profitability of each dollar of sales. It tells us how well the company controlled its expenses, all of those expenses, not just operating expenses, not just cost of goods sold. How can we increase the net profit margin? By increasing sales revenue by a greater extent than any increase in expenses. Again, easier said than done. Or decreasing expenses without a reduction or an equal offsetting reduction in sales revenue. Of course, easier said than done. What items would appear in net profit margin that would not be included in operating profit margin? Thinking about what are those items that are in the non-operating section of the income statement? The biggest one is typically interest expense, but you're also going to see interest income and dividend revenue. Sorry, types of investment income. Gains and losses, non-operating gains and losses, so gains and losses on long-term assets, investments, and sales of long-term assets, buildings, equipment, if we sell intangible assets. And also tax expense is not included. It's not in the non-operating section, but it's not included in the operating income or our operating profit margin. All of these items would be included in your net profit margin. And net profit margin is usually, but not always, lower than operating profit margin. And the reason for that is tax expense and interest expense are usually the biggest items that affect the difference between, that result in the difference between operating profit margin and net profit margin. Here we see the net profit margins for our three companies. And what do we see? The company with the highest sales revenue actually has the lowest net profit margin. And we saw that what this is a result of with our operating profit margin. It's a result of PepsiCo not controlling its operating expenses as well as the other two companies. Here is Apple's income statement for 2020, the year end of 2020, both in dollar amounts and in common size or vertical analysis. And when we did this common size analysis, we didn't call this number here our gross profit margin, but that's what it is. It's our cost of goods sold, or our gross profit divided by sales. Our operating profit margin is our operating income divided by sales, and our net profit margin is our net income divided by sales. So we looked at those amounts, and last week I tried to focus more on our costs as a percentage of sales. And what's the result when we take our sales less our costs? Our results are these subtotals on the income statement that we're looking at: gross margin, operating income, and net income as a percentage of sales. Here are three commonly used profitability ratios that take information from the income statement and compare it to the balance sheet. Asset turnover is equal to sales from the income statement divided by total assets on the balance sheet. I'm going to put a little asterisk here next to the total assets, and we have it defined here. Typically, the denominator is going to be average total assets. So every balance sheet is going to report the most recent period and the period prior. That's because we're saying what we started the year with, last period's ending balance, is what we started this current period with, and then we can use this period's ending balance. That's a better measure of what we had throughout the period compared to sales. So our numerator here covers a period of time. We've been looking at annual, so the 1 year of sales compared to assets that are at one period of time. Just for simplicity, we're going to be using total assets, totals rather than averages. And this ratio asset turnover compares the amount of sales dollars generated from a company's assets. And that's what those assets are supposed to be doing, right? They're supposed to be helping the company generate sales. The more assets we have, the more sales we should be generating. How can we improve asset turnover? Well, we look at each of those assets and say, what are these assets bringing to us as time goes on? Do we have too much cash that's just sitting around, not collecting any interest revenue, not collecting any profits for us? Or do we have too much of our assets tied up in accounts receivable? We can't earn any revenue on our income on our accounts receivable. Are our investment securities generating enough of a return? Are we taking enough risk with those investment securities? Do we have too much in investment securities? Can we hold less inventory without, of course, that impacting our sales? Can we have a higher inventory turnover, get our stuff in and sell it quickly without having to tell customers that we don't have any merchandise for them? Should we sell some plant, property, and equipment because it's not being used enough? And are our intangible assets helping us generate sales? Here we see the asset turnovers. We see the dollar amounts that go into the asset turnover calculation as well as our results. And here we see, well, we looked at the profit margins for Pepsi. We saw that they were lacking. Here we see that Pepsi has the highest asset turnover. So we can say that although they have almost the highest amount of assets, they're almost tied for the highest amount of assets, they are generating a lot of sales with those assets. The next ratio that we're going to look at is return on assets. Again, when you hear return, you think the numerator is going to be net income, And we know what that denominator is because it's in our ratios name assets. So let's compare net income on the income statement to total assets. And again, typically going to look at these as average, but for simplicity, let's just take the totals. How much income did we generate from our assets? So compares the company's net income to the company's, you know how to finish this, investment in assets. High ROA depends on managing assets investments, making sure they are productive assets that we have, and controlling our expenses, because asset turnover only included sales, but return on assets is net income, so sales minus our expenses. Keep net income high. So management wants to think about, can we reduce our assets and or expenses and still maintain sales? Here we see ROAs for our three companies. We see that while Coca-Cola has the greatest investment in assets, so we want to see the highest net income being generated from this high amount of assets, we actually see the highest ROA from the company that has the lowest amount of assets. So we would say Monster is using its assets most efficiently to generate income. Although Coke has the highest assets and highest net income, its assets are not producing nearly enough income compared to that of Monster. And our margin analysis shows us that Monster was able to control its expenses and keep a greater portion of sales dollars as net income. Finally, let's turn to return on equity. Return means put net income in the numerator and divide this by total stockholders' equity. Again, typically we're going to use the average amount since net income covers a period of time and stockholders' equity is at a period of time. For simplicity, I'm just going to use total stockholders' equity. And it compares net income to the company's, you know what this is going to be filled out as, stockholders' equity. I'm going to use the term book value of equity, and we're going to define that on the next slide. It's just another way of saying total stockholders' equity. And management wants to know, can we reduce our stockholders' equity and or our expenses and still maintain our sales? This is how we can increase our ROE. On the next slide, we have some information about return on equity. Total stockholders' equity is also called the book value of the firm, or simply book value. It comes directly from the balance sheet, total stockholders' equity. It equals the sum of common stock and additional paid-in capital, which we refer to that as contributed capital, contributed capital plus what else is a part of stockholders' equity? Retained earnings. What is an additional component of stockholders' equity that we've covered recently? Accumulated other comprehensive income. And then the other component we're going to see of stockholders' equity is treasury stock. And let's just include that this is a contra equity account. So we would add up contributed capital, retained earnings, accumulated other comprehensive income, and then we'd subtract treasury stock. And we mentioned that total stockholders' equity is called book value. That's different from market value of equity. Investors typically talk about the equity of a company being the market value, and that's something separate. You can't find the market value on a balance sheet. The market value of a company is equal to the number of shares of common stock that it has outstanding times the market price per share on a specific date. The market value of equity is not used in ROE, so that's an important point to remember. So how can we reduce stockholders' equity? If we know that if we're not changing net income, in order to increase return on equity, we can decrease total stockholders' equity. How can we do that? Well, what affects stockholders' equity? Net income and net loss. Obviously, we don't want to have a net loss to decrease stockholders' equity with retained earnings. But dividends. Dividends decrease stockholders' equity. So we can increase our ROE by increasing our dividends. One thing we want to keep in mind when we're considering doing this is that dividends are known to be sticky, meaning that if investors receive a certain dividend this period, we know that that's going to reduce retained earnings and therefore reduce stockholders' equity. But it makes investors happy because they just received cash. But once they get that, they become accustomed to it, and they're going to expect that same amount of cash. So it's a little bit risky to increase dividends as a method of purposely reducing stockholders' equity. What else can a company do to reduce its stockholders' equity? It can do a stock buyback, or in other words, acquiring treasury stock. That will decrease stockholders' equity. Really, the only drawback to this is that it requires the use of cash. So if a company has to actually buy its own shares of stock, that will automatically reduce stockholders' equity and therefore increase return on equity, which is good for investors. And it doesn't affect sales or expenses. So as long as we have the extra cash, we know we can buy our shares, increase ROE, and not affect net income. What about if we have a new project, a new investment opportunity, but we don't have that cash? What can we do? Well, we can avoid issuing new shares of common stock, which would increase stockholders' equity and decrease ROE. So when in need of cash, what can we do instead of issuing stock? We can borrow, issue debt, which means issue bonds or issue notes payable, maybe loans from the bank. What's the downside to issuing debt instead of issuing stock? Well, stock never needs to be repaid, but debt does. And too much debt makes the company risky and can put that company close to bankruptcy. Here we see return on equities for our three companies. Coca-Cola has the highest amount of equity, so that's should be producing the most income, but we can see that Pepsi actually has the second highest equity, but the highest return on equity. The next part of this video is to do basic profitability analysis to continue our analysis of Coke, Pepsi, and Monster, sticking to our 6 profitability ratios. We're going to look at open up your Excel file with your data set for this week. And we have a data set of all publicly traded companies with financial statement information for the fiscal year 2021. I took just the variables that we need: revenue, gross profit, operating income, net income, total assets, and total stockholders' equity. And from that data, I easily calculated the ratios that we've used in this video. Let's look at answering the following questions with the data. How do the profitability ratios of Coke, Pepsi, and Monster in 2021 compare to those of all firms, all publicly traded companies in 2021? How does it compare to just those firms in the same industry? And I'm going to use my data sets as industry classification for food. It puts Coke, Pepsi, and Monster all in the food, beverage, and tobacco industry. So that's the industry we're going to use. And then how do the ratios for Coke, Pepsi, and Monster compare for 2021 compared to those of the 4 years prior to 2021? So we can look at a time series analysis. So let's switch over to our Excel file now. Here's our data set with ticker and company name. Again, all companies that had publicly available financial statements for the fiscal year 2021. Financial statement information that we need for to create our variables. All of these dollars shown are in millions. And then finally, our formulas, our ratios that are generated from this data set. So for example, our gross profit margin is equal to our gross profit divided by revenue. We have about almost 5,000 companies here. To get to the bottom of my data set, I'm going to hit Control down arrow. That's going to take me to my last row. And what I want to do to get an idea of how did these companies do without looking at almost 5,000 variables, I'm going to look at the median values in each one of these ratios. So for gross profit margin, let's take the median, cells K2 through K499. 999. And I get the median values. Why do I want medians rather than averages? Well, the averages, some of these data points have some outlying data. The medians allow us to give us some summary information from these values without having to include the influence of those major outliers. So our median for all publicly traded companies in 2021, the median gross profit margin was 42%. Median operating profit margin was 10%. Median net profit margin was 6%. Median asset turnover was 37%. So we can say for every dollar generated in assets, On the median, the company returned 37 cents in sales. Return on assets was a median value of 2%, and return on equity is a median value of 8%. Now we're going to compare these median values for our entire universe of companies to those of the median values for our 3 companies. But before we do, let's get one step closer by looking at the data just for the industry that Coke, Pepsi, and Monster are in. So our data set classifies them in the food, beverage, and tobacco industry, and I have that data here in this next tab called Industry. We have just 27 companies in this industry in 2021, and again, let's calculate the median values. This is going to give us a better way of comparing to how did the market do when we look just at the industry and not at all the universe of all companies. Drag this over. And then on the next tab, we have our 3 companies that we're interested in, Coca-Cola, Pepsi, and Monster Beverage. Here's the data that we had from our PowerPoint slides, just put into a different format here. Let's copy over the industry median amounts. I'm going to copy these. And I need to paste the values under gross profit margin, operating profit margin, and so forth. And I'm going to label this industry medians, industry median. There's a lot of data here, so let's put in a chart to put this in a somewhat of a nicer format. I'm going to go to Insert. I like to start with recommended charts and see what Excel tells me. Now we can display this. There's no one right way to display this information to make it easier for us to interpret. I like this clustered column chart that Excel is offering me here, so I'm going to click OK. I'm going to put the title, Profitability Analysis. And now I see each of my variables one by one for each of the 3 companies as well as the industry. And that makes it easy to see that all 3 of my companies did better than the median value of the industry in gross profit margin, just slightly in operating profit margin, net profit margin, ROA, and ROE. We can see that one of our companies, Coca-Cola, didn't do as well in asset turnover as the median. All other values, our companies did better than the median. We can see how for certain values, such as operating margin, we can see that Coke and Monster were fairly close, and we can see that Pepsi lacks in operating profit margin and net profit margin, which we also looked at in our Excel data when we looked also with the dollar amounts of revenues, gross margin, operating income, and net income. Asset turnover, we see here that Pepsi had the highest asset turnover, followed by Monster. ROA, we see that Monster had the highest ROA, but it did not have the highest ROE. Pepsi and Coke both had much higher ROEs than Monster. If we want to compare our industry medians and our company-specific profitability ratios to the entire universe of companies, I can come back to my all companies medians, copy them, and paste them. I don't want them included in my chart. So how did this food, beverage, and tobacco industry do compared to the entire market of companies? Our industry did better than all companies in gross profit margin, operating profit margin, net profit margin, asset turnover, and ROA. The only profitability measure that our industry did not do better in was an ROE, and it was very close. So we can see that it was a good year for the food, beverage, tobacco industry. One more analysis is to look at our 3 companies over time. Here we have our companies broken out one by one, each company at a time, for the most recent 5-year period for each of our 6 variables. So because this is a lot of data here, let's build some charts. Again, I'm going to insert, let's try recommended charts. I like the line chart a little bit better than the stacked area chart. but they're both going to give me the same information. So this first one is for Coca-Cola, so let me rename. So what can we say about profitability analysis for the last 5 years for Coca-Cola? Well, we can see that gross profit margin was relatively stable, decreased just a bit. We see some big variability in the ROE. You see there was a dramatic increase in ROE from 2017 to 2018, and then a small increase from 2018 to 2019, and a small decrease, fairly stable after that in ROE. We see that asset turnover was at about 40% over the period with some small fluctuations. Operating profit margin seemed to stay at about 30%. Net profit margin increased dramatically from 2017 to 2018, and then since then it's been between 20 and about 25%. Return on assets increased also from 2017 to 2018, and then it has remained at about 10%. Now let's look at Pepsi's data. So I'm going to go into my Pepsi's table of data here, insert recommended charts. Again, I'm going to do a line chart, label it for Pepsi. And we see some big variability here in ROE. That's where we saw the most variability for Coca-Cola as well. We saw relatively stable changes in all of our other amounts other than ROE. And we see that again for Pepsi. Now I can go to the financial statements. I suspect that it may be due to acquisitions of treasury stock or reissuances of treasury stock, but I wouldn't know for sure unless I went back to the financial statements to see. What do we see here for Pepsi? We see very flat, very small changes in asset turnover, relatively flat over the period, gross profit margin, operating profit margin, net profit margin, and ROA, all relatively flat over the 5-year period, only some variability in ROE between 2017 and 2019. Now let's take a look at Monster energy drinks. And again, I see quite a bit of not too much variability. I see a decrease in asset turnover, small decrease in asset turnover. It was a little over 80% back in 2018, and now it's getting close to 70%. I see relatively stable gross profit margin, although I do see some decrease from 2020 to 2021. And I also see this slight decrease in operating profit margin, net profit margin, ROE, and ROA. I see slight decreases from 2020 to 2021. So that's definitely something an investor is going to want to keep an eye on. Over the 4 years prior, things are pretty stable, but from 2020 to 2021, we see some decreases that could be some cause of concern. This concludes this week's video and our discussion of these 6 basic profitability measures. We're going to look at these measures in further detail and try to better understand what's causing our changes in ROA and ROE, what's driving them as we continue over the next several weeks.